Just want to talk about two buzzing stocks from yesterday. And one of them has got to be Reliance Industries. 4 consecutive day of steep losses coming in for Reliance. And, you know, this is coming in the back of high volumes. I mean, when else do you have a nifty stock move 2.5 to 3% in just one given day, and that too on just, you know, a one-way ride? That's downside. So yes, the volumes have been higher, almost twice the 20-day averages in Reliance. It's posted the worst that it has in all of 2019. And the losses are now counting to nearly about 30,000 crore rupees in market cap. It's now been testing its 100 DMA support. Let's take it across to Sandip Sabharwal. He also joins in the show. Sandip, hi, morning. What's next for Reliance and why this acute fall?
Like, the reasons were very clear when the results came out, because the kind of debt levels they have built up, especially on the Jio side. So if you look at the total debt on the books of Reliance, around 3 lakh crores. So 1.5 lakh crores could be just because of Jio, what the investments they have done. And the profit, net profit they are making per quarter on Jio, despite 30 crore subscribers, is just around 800 crores. And that levels doesn't seem to be going up. Now, if that is at record high operating margins of 39–40%, so if that's the scenario, then there is significant need of deleveraging, because telecom unfortunately is an industry which requires continuous investments just to maintain your network upgrade, and then you have 5G coming up in 1.5–2 years, so you'll need investments for that. So now deleveraging so for deleveraging, then deleveraging should happen in an equity fashion. So a lot of analysts came out with report the balance sheet is delevered because they have transferred the assets and the liabilities to a wholly owned subsidiary. A wholly owned subsidiary, how does it deleverage? Because it's still a part of Reliance. Now there are two ways they can get in money. One is through a InvIT structure, or the second is pure equity infusion. So InvIT structure also doesn't help, because then you have to pay interest to the InvIT if you get in the money. So the only way is get equity into that. Whether they'll be successful or not, I don't know, because the equity infusion has to be substantial. Like, it has to be $4–5 billion for it to make an impact. So that's something we need to watch out for. If that happens, then maybe Reliance will again start participating or outperforming. Otherwise, I think it should remain underperforming stock.
So if you're a shareholder in the money, do you profit take right now? And if you're a new investor, do you buy this decline?
So new investors shouldn't be buying now, because you look at the sheer outperformance it has given since the beginning of 2018. If I'm not wrong, it must be still around double of where it started off from. Yeah. So then it's given huge returns. And from existing investors' standpoint, like if you are benchmarking the index, then it has the highest weightage in the index, so you obviously keep something. So they are benchmarking investors, and if you are not a benchmarking investor, then any bounce back you can use to trim your holdings and possibly shift to something else.
28%. I just want to go to that smart stock edge. You know, this is the new segment which we've started, where on a daily basis we'll focus on 2–3 stocks where there is price action. Look at Reliance. It is still up 28% in the last 1 year. It's just one of those massive outperformers. And I think now markets are noticing that there is a large mountain of debt which got created, and Jio was essentially being created on that mountain of debt. The mountain of debt now has started to hurt them. And I think recognition is coming, because we reported a story that Jio may be looking at selling stake to SoftBank. The Times of India did a story saying that they could be looking at selling their partial stake in the refining business. So Reliance now needs to really convince market that they can manage such a large debt at a time when the old business, which is the refining and the petrochemical business, is slowing down. Look at the P multiple, it's at 18.5 times, the 5-year P average is 13 times, and the 1-year P estimate is at 15 times. So it is trading at a P multiple which in general is higher than the the average historical multiple they've done. You can argue and say that okay, they've got Jio, but again Jio is not making money. So you still have to value Reliance on the potential of the old business, because when Jio will make money, we'll talk about a different P multiple. And as it is, telecom companies don't get too much of P multiple these days for the kind of wealth they're destroying. The second stock which I'll throw at Sandeep, and then we'll get CK and Kunal to debate on that. We'll get you the fundamental side and the technical side, and that stock is not Reliance, it's Z. It's been in news. It's seen a massive compulsive selling, but Z is a great franchise, and it's a franchise which needs to be valued correctly. The stock is down 40% in last 1 year. Sandeep, there is a problem. We know that, markets know that, everyone knows that. But do you buy the problem with the hope that the management is trying to scream, shout, yell, whisper, whatever they can do, they're trying to convince the market that, guys, we will do a deal? Do you buy and take a leap of faith? Because if you take a leap of faith and believe that the deal is going to be structured, then the stock's not going to trade here in 6 months.
Yeah, so there are two ways of looking at it. One is purely just on fundamentals, assuming that no deal happens in the near future. So then what could happen is, one, some pledge shares could get sold. So if those pledge shares get sold, then obviously there's a damage which we saw a couple of days back.
The damages are very large, Sandeep. That's
yeah.
the only problem.
So that's what I'm saying, that those damages can happen. So any investor who is looking at buying this stock purely on a fundamental basis has to keep that risk in mind, that can happen. So if you are willing to take that risk and play it purely on fundamentals, then even without a deal at 350, 360, it's a cheap stock relative to its current fundamentals. Because if you remember, before this entire hoopla started, it used to be at 500 plus.
Yeah, 450.
It was 500 plus. So it's down 30% from those levels, and that was a valuation, no deal valuation. So now we don't know. See, managements are always confident that deal will happen. So and they have been saying so much that they will be compelled to do a deal. I think then the question is whether it's a good deal or a bad deal. Now, so I think there are too many important levels, but purely on fundamentals for people who are willing to take some risk because of a sell-off due to some pledge shares getting sold. I think at 360 there's value.
Just hear that, just one, no, Aisha, just again that, for me this is a sum and summary of what Sandeep is trying to say. The 5-year average for Z, and purely based on its business cash flow, is 34 times. Current P is 23 times. And it is trading at a discount to what its historical average is. And if you just look at Z in isolation and say, Z ka dhanda main kaise value karunga? How will I value that business? The historical P is 30. Now what's happened to the SL group of companies, what's happened to the other group companies, what's happened to other businesses, that's happening at promoter balance sheet. Will that have an impact on the existing business model of Z? I doubt it very much. So there you go. If you're buying it fundamentally, like Sandeep said, the stock is available at a price which is below its 5-year P average.
And from the deal standpoint, at least they could sell SL Propack. Yeah. SL Propacks got sold, so at least they've made one deal within the group. So that gives some confidence that maybe this deal will happen.
Why should one not buy SBI? Because it's giving me everything what ICICI Bank is giving me at a cheaper discount. Cyclical recovery, subsidiaries, listing of insurance. It's giving me pretty much everything at a discount.
The discount is there, but the difference is that one, ICICI is in a stronger credit growth cycle than SBI. ICICI has a much better capital adequacy than SBI, so ICICI doesn't need to raise capital. SBI does have to raise capital eventually. And thirdly, ICICI over the last 1.5 years did not, so ICICI is not facing the issues related to exposure to ILFS and its subsidiaries, or for that matter, excessive funding to NBFCs. So because when the liquidity crunch came up, SBI sort of, and many PSU banks funded a lot of NBFCs, so I think that could become an issue. ILFS exposure is above 10,000 crores, as per whatever reports I've read. So what kind of provisioning will be required because of that? And even after ICICI not getting into many of these troubled issues in the real... Who? SBI. They have been there for a long time, but what I'm saying is ICICI, despite not getting into any of these troubled sectors in the near past, they still had significant provision even in this quarter. So SBI's provisions could be higher than what people are expecting. That's my only concern, so I would like to watch out for that.
Yeah, because the ILFS exposure also has to be done in this quarterly performance.
Yeah, I mean
right?
that explains why IndusInd Bank has cracked. I mean, because you were the court ruling came out that you have to completely write it off in terms of an NPA provisioning. Even though ILFS has been saying that we've been conservative with the IL&FS exposure, but I think there is a little bit of residual is still left, and that's what markets think that is going to be washed out. So you just want...
And SBI would have a high exposure.
At their size, they'll have exposure, they have the pies and everything.
Because IndusInd recoverability is very low because it was some bridge funding unsecured. So I think IndusInd money might not come back at all. SBI depends on where that entire money is gone. Whatever they have funded SPVs, that will eventually come back, I guess. But whatever has been funded to the parent, I think that will have to be written off.
Well, if not IL&FS Jet, SBI has lots on its platter.